For today. But if you've just joined us, better late than never. And the good news is that the recordings of all the sessions from today will be available on this platform for on-demand viewing after the end of the event. So if you missed anything, you can still view it later on. We don't actually have a lot of time left, so I'm just going to do some really quick introductions of our panelists. They actually did full sessions earlier in the day also. So if you want to know more in detail about their views and what DLCs and warrants are, do check out their sessions earlier. But quick introductions, Mr. Wong, he's an investment strategist who manages his own fund, and he has over 2 decades of trading experience, and he's the founder of Weipedia, which provides training as well as expert witness service in trading, dispute arbitration. Mr. Robin Ho is a top-tier trader and remisier with Phillip Capital. He's trained and mentored thousands of professional traders. You would literally see him, at public events pre-COVID, swarm like some rock star. That's Robin Ho. Mr. Keith Chan is the head of listed distribution at Societe Generale, and the man you want to talk to about DLCs, similarly, Mr. Darren Zeng, is a warrant sales analyst with Macquarie, and if you have questions about warrants, he's your man. We're going to start with Keith. Keith, you work for SocGen. You're the company that does DLCs. For someone who has never heard of DLCs before, could you just give us the really DLC 101? And I believe Robin can also help you with some of his DLC trading records to help illustrate what you're talking about. Keith.
Sure, thanks Ed, and thank you everyone for joining the session. This DLC product stands for Daily Leverage Certificates. We're very excited that the product actually have done very well in the last 3 years. So it was first launched on the SGX at 2017. It's a product that tracks certain underlyings, being the index, let's say the Hang Seng Index, or some single stocks. We have some DLCs that track Hong Kong shares as well as some Singapore shares. The main feature of DLCs is it has a leverage. So it has a fixed leverage, say for single stocks of 5 times. So what that means is 5 times fixed leverage. So whenever the stock's daily return, its daily performance, it will provide you the 5 times leverage of that. So if the underlying stock goes up by 1% in the share price from yesterday's close, the value of the DLC, right, will go up 5%. From previous close. So it works very much like an ETF, where ETF tracks 1-to-1. A lot of investors have traded leverage ETFs that gives you maybe 2 times, or in the US, you got some 3 times leverage ETFs. But DLCs work in a very similar way, but with higher leverage. And the other thing is it tracks certain index or single stocks. Now, what's very exciting the last 6 to 12 months is that we have increased a lot of our DLC issuance over some Hong Kong stocks, particularly some of the China tech stocks. So right now, the very actively traded DLCs, their underlyings are, stocks like Tencent, Meituan, Xiaomi, these kind of stocks. And this, because there's a lot more Hong Kong tech names coming to going IPO into Hong Kong Exchange. So we feel that DLC has become a very good instrument for Singapore investors to trade, on the SGX with Sing dollars with an exposure that's linked to these Chinese techs with leverage. And don't forget, DLCs, you've got long and you've got short. So if you have a bearish view of an underlying, you can always pick a product that is the 5 times short on a particular stock. One last point, very importantly, is actually the other benefit to trade DLC versus Hong Kong stocks is the capital that you need to trade. So if you buy one lot of a Tencent, it's going to cost you about 10K Sing dollars just for one minimum lot. But to trade DLCs, they are in a lot size of 100 units. So you can trade with a few $100, you can already get an exposure to a huge stock like Tencent. And remember, trading Hong Kong stocks, you've got stamp duty, right, of 10 bips. And the Hong Kong government have recently announced that they might look at even increasing that stamp duty. But if you trade DLCs on SGX, there's no stamp there. So as a trader who wants to trade actively, right, cost is important. So I urge you to look at this product closely. Go to our website, dlc.socgen.com, and find out more and educate yourself about the instrument. Thanks, Ed.
Thanks, Keith. And we'll be talking to Robin about that very soon, actually. But before that, Darren, we'd like to hear about what warrants are. Tell us all about it. Well, I mean, you don't have much time, unfortunately. So tell us, give us the short version, as it were.
Okay, thank you, Ed. And also thank you, Keith, because I'm very excited to share about structured warrants because likewise, structured warrants are listed on the SGX. And over here on structured warrants, you also have the opportunity to go long and short in the current markets. So some features as to why structured warrants has been in the Singapore market for 16 years and remains one of the most popular products. First of all, because it's listed on the SGX, you get live prices and transparency over all these warrants during the Singapore trading hours. Second of all, because we have liquidity as a market maker, we offer constant bid and ask volumes, and that's why investors are keen to actually trade such products because they can enter and exit their positions easily. And last, also one more thing, which is gearing. So as listed leverage products, the name suggests, leverage, another word we use in warrants is called gearing. Warrants have the highest gearing for all listed leverage products in Singapore, from all the way from 3 times to 20 times. So this allows our investors to select a warrant that fits their trading profile. And last of all, structured warrants are relatively cheap compared to the underlying stocks or index that they are covering. So warrants, usually you find trending warrants between a range of maybe 2 cents all the way to 15 cents. And whereas for stock, you can go all the way to hundreds of dollars, whereas for indices, usually you take hundreds of thousands. So that's a brief introduction of warrants. And also one thing about warrants is that we track, in terms of underlying that we track, we constantly update the list of underlyings to make sure that investors have exposure to the most exciting stocks or indices in the world right now. So for indices, we cover US markets, the S&P 500, the Nikkei 225, the very popular Hang Seng Index, and we're also excited to announce the new Hang Seng Tech Index that we have listed this week. So for Hang Seng Tech Index, the effective gearing is 5 to 10 times. That means a intraday move of 1% in the Hang Seng Tech futures would mean a 5 to 10 times, 10% increase in the Hang Seng Tech warrants. So investors can always continue to look out for warrants because every time there's something interesting, we'll be there to try to cover it. So I think that's for warrants, and happy to pass it on to
Thanks very much, Darren. Really appreciate you doing that that introduction for us. So very clear, very concise. And since we're talking about warrants, let's start with Khun Hao. So Khun Hao, well, Darren did say excitement. So a lot of people will be very excited to hear you say this, okay? How do you think markets are going to move from here? And what are your 3 market plays for this year? Oh, Khun Hao is still muted, I'm afraid.
Thank you. I'm all excited to share. Let me just share my PPT. Yeah, give me a moment. All right, I think before I start, just do a quick disclaimer here. So what I'm going to share is really based on my conviction and excitement on the 3 markets. But all this conviction, my view are for my personal consumption. So if you are somewhat influenced by my thoughts, my excitement, so coming Monday or next week or next month, you think about what I shared today, so relevant, you want to take action, so please consult your licensed body. Okay, just going to get started. So I'm going to talk about the US market, S&P. I'm going to use Dow Jones to represent that for the US market. Then I'm going to move on to the Hang Seng Tech Index and then STI. So I'm just going to give you a more holistic, the main trend, the bigger picture. So because earlier I spoke about in the earlier session is that once you have an idea about the main trend, the super long trend, basically if a super long trend is an uptrend, so basically even for short-term trader, because the topic today is about trading festival, right? So about more on the short term. So once you have gathered an idea about the long-term investment, the main trend is up. Even as a short-term trader, I will focus on one thing. I will try to flow with the same direction, buy on dips. But that doesn't mean I do not go against. It's just that when you go against, you try to take, because you're against the trend, then you take a shorter term view. That's where structured warrant, VLC became very heavy traders and also investor like myself. Investors use those to hedge, and traders, we use them to trade them as well. Okay, for Dow Jones or S&P, my view is this. Basically, I'm seeing uptrend still. I'm talking about the big picture. Of course, last Wednesday, Thursday, Friday, things have changed. Risk, high risk, why? I'm going to explain to you very shortly. volatile, whenever there's volatility, is good news for traders. It's not a good news for investor. So when there's volatility, it means that there are trading opportunity. So mainly, I think for US market, for the long haul, long term is still uptrend. But sometimes we have to place, let's say this is a 40 years uptrend. We have to place where is it right now for the US market. So I'll place that US market as here, maybe towards the end of this super uptrend. So we got to be very careful. Yeah, volatility is still there. There's always trading opportunity, but the macro, we got to be very cautious. So if you ask me to invest in US, no, I'm not. I would prefer to trade the US market, use structural warrant to trade the US market when there's opportunity. But invest in a very dangerous long-term perspective. I'm always concerned that what if I got stuck if I'm not careful enough. So trading will definitely my back for the US market, because once I switch on my trading hat, I have to react fast if things start to turn south and the otherwise. So I would position that maybe for the long term, US is about nearing the top, still on an uptrend. So the reason maybe this week, the weeks that have just passed, of course, there's a lot of volatility and down move. I would classify at this point is still a long-term uptrend, but maybe what US is taking a breather right now for the next few weeks to come. But is it going to point out to be a major reversal? I think yet to tell. It could be just taking a breather, you'll bounce back up, where US are always capable of it, but just got to be very cautious on the US market. This is one demonstration I have. For US market, I'm quite concerned that a lot of my friends say that, Konghao, don't worry, US market 100 years has been going up. Is that true? Not quite. Now you look at this demonstration from 1910 to 1980, US market, beginning of 1910 to the close of 1980, US market has trapped in this range 2,500 points. US market only has been trending up since 1980 until today for the last 41 years. The reason is fundamental shift. US became in 1980, between 1971 to 1980, there has been a world reserve currency. The world need US dollars, and things have changed. Therefore, you can see an uptrend. So US became quite easy to trade if you single-mindedly just buy on dips over the last 41 years. Okay. So, but however, US also have a cycle. Everything have a cycle. If you look at very closely, very carefully, after the Great Depression to 1980, there's a 45-year cycle. Correction, the real correction is about 70%. If even I bring back to 2029, the Great Depression is also about there, beyond 70%. So all these years we experienced a mini hiccup is not really a turnaround. It's just a market taking a breather. So from 1980 to today is about 41 years. So we just got to be very cautious that if you're a long-term investor, I'm very cautious, which I don't take much position for US market for my investment portfolio, but rather more of the trading portfolio, because I move in fast, get out fast as well if things start to change. Now I'm just going to move on to the next. Just want to give you some highlight. Then after that, I'm going to move on to Q&A. We can answer more questions on the relative market I just spoke about. For the Hang Seng Tech Index, what is Hang Seng Tech Index? Basically, I'm going to share with you very shortly. Hang Seng Tech Index mainly are the tech stock. It is the Nasdaq. Nasdaq is of US, but Hang Seng Tech Index is the tech stock in Asia. Okay, so my trend, I felt that it's still uptrend. Risk moderate, because if you talk about the tech stock in Asia, I think it's just at the beginning. You know, there's still more upside to go. Volatility, yes, definitely. There's a lot of trading opportunity. So if I'm going to place where is Hang Seng Tech stock today, is here. Okay, or Asia Tech stock, it is here. Now, of course, we always look for a biting point. Earlier I said that, yeah, although it's uptrend, that doesn't mean that we sell. Just that when we sell, we may want to take a short-term approach instead of a long-term approach. So that's why I see in last Friday, I have this video clip with Macquarie. Every month I produce one. And that was last Friday. Based on last Friday's study, it indicated there is a potential weakness for the Asia Tech stock, which is a Hang Seng Tech stock. As you see, it is a 30-year last. Yeah, no time to explain. You can read for yourself. Now, so basically, as of close of last Friday, we produced a video with Macquarie that for this week, which just passed, I'm positioning that to do a short-term sell for the tech stock. And it did really well. You could see from Monday, Tuesday, Wednesday, Thursday, and Friday it sink all the way below to 8,009. It's just amazing. So of course, Then structured warrant became how I use all these leverage or gearing stuff is that the thing is this. Last Friday closing, there's a point of confidence there. Basically, it shows that as a trader is this, you have to derive the point of confidence. The greater the confidence you have, the greater gearing you should deploy, okay, with a measured risk. I'm just going to repeat that. You've got to build up the skill. The greater confidence at the point in time you have, the greater gearing I would deploy that, okay, with a measured risk. So that's trading all about. So lastly, I'm going to place the STI. And what's STI? Basically, I find that STI is just at the beginning of a super uptrend. Beginning of super uptrend, which I'm going to explain to you very shortly. Risk moderate. Volatility also moderate means that you may not have a lot of trading opportunity, but once in a while they'll have trading opportunity. But the thing is that for STI, the risk is very minimal. Why? It's only at the beginning. Okay, I have no time to explain to you because we are each given about 10 minutes. I think my time is going to end soon. So basically, these are 25 years history about Singapore market. You can see that these are the Asia Tiger stages, then level. And for the last one, we're in Singapore market, we're like in the wilderness, for 10 years, moving nowhere. But you could see that in a growing market, we're moving from strength to strength, from stages to level. Level is a previous resistance, is today's a support, right? But I felt that there's a biting point that moving forward for the next 30 years, Singapore will not be the same. The fundamental shift, just like the US, the fundamental shift for US market and it is became a reserve currency. For Singapore market, it's different. If you look at very carefully, from an old economy that we have and all this listed product, we're moving into the high-tech companies right now. If you're not too sure, you look at the top 100 tech company in the world. 80 of them have their foothold here in Singapore. So things are looking very different 10 years, 20 and 30 years from now for Singapore market. So this is Singapore market, okay? I just wanted to take a snapshot, prepare a camera or do a screenshot. Now, Singapore market from stages, level to stages, and look at the US market from stages, level, stages that's 1980, and then the trend started to pick up. So I just want to see that, because when you combine technical and behavior analysis, it became a very powerful instrument. It gives us the precision in timing the market. For example, now technical analysis, if you can use it, means that the previous resistance, that was 2000.com boom, the previous resistance became a current support. But if you're going to add in the behavior analysis. Now, what's behavior analysis means that we study into the market psychology. It makes a lot of sense though. Now, yeah, TA would say that the previous resistance is today's support. But the previous resistance is created by a lot of emotion back then in .com boom. And those that have invested then, you know what I mean. There was a lot of drive, a lot of weakness in the market. Behavior analysis have to include the emotion. Now, and that makes technical analysis really fundamental here, is that the previous resistance became today's support. Now, I freeze the screen here on 12th of May for a reason, because then at a point in time, I'm quite convicted that the market should have the support. Although it go all the way down to 2208. Now, there's another level of support here was during the Asia boom. I was an army personnel. I still remember I carried a picture to my army. My staff sergeant asked me what stock to buy. Asia boom, the previous resistance was at 2002. So because of the pandemic last year in May, I formed an idea that there's a support zone between 2002 to 2005. And I'm quite convinced that is about there. And moving forward, I think the support is so strong, combining TA and BA. And I did in fact, in Hong Kong, one of the broker, very renowned broker, that July last year, there was among the institutional investor outside Asia, they started to acquire a lot of Singapore stocks through Hong Kong. So they called me up and asked me, do you know why? Do you know what's the reason? I said, yeah, I think I know why. So I presented a topic to Hong Kong, to the international institutional investor, to about 300 of them, 39 nations. And I explained the reason why it is time to look at Singapore for long-term growth. So once the trend starts to pick up, it's not just for long-term investment, but it's also for short-term trading. Remember, buy on dips as the trend starts to pick up. So I think I'm quite done with my presentation, and I just want to showcase that this is November last year. I did this talk with the institutional, with the broker to 300 participants, 49 countries. That's November here. But before that, in March and April, you could see that there's a bullish engulfing body. It's not just technical though, it is behavior analysis, which I'm going to describe to you much more during the Q&A. So November I was giving a chance to showcase Singapore. I'm very excited. Then shortly after my presentation, it performed another bullish engulfing body. Basically the biting point, the precision entry with heavy weighted. Okay? It's not just any other bullish engulfing body, but one that's very significant. And many of us have missed out this Singapore market. There's also a double bottom that has already formed. Yeah, the US market may come down, that will affect Singapore, but I see it differently here. When US market is down, Singapore may also move down, but in a lesser magnitude. But this is where I would like to start to acquiring more stock, not just for investment, and also for trading in the structural product as well. So you may want to join me for this talk, which I presented at Hong Kong in my home, my comfort of a home. That was in November last year. A line that rolls in the time of uncertainty. This is free. So this is for it. It's a 1 hour program. You'll get an insight why in Singapore is definitely a must to invest in us for the next 30 years. Okay. So for those that are very keen to understand about what do I mean by precision entry, what do I mean by combining the two, the TA and BA together to form a precision entry or the biting point, you can attend this program. It's a paid program, but at the moment there's a 20% discount up to coming Monday at 12. Hardly give any discount, but just for this event. So this will apply not just to trader, it will also apply to income, value, and growth stock investing as well. Okay, so with that, I want to pass this time back to Edward.
Thanks very much, Kon Hao. Much appreciated. Wow, very, very comprehensive too. We're going to move on to Robin right now. We'd like to hear about your forecast and your 3 market plays for the year. And we do know that you want to talk about the frothiness in the market, whether there's a bubble forming. And you're going to talk a bit about the sectors with regards to infotech and healthcare also, right? So I'm going to trouble Kon Hao if you could stop sharing first. There we go. All right, Robin, over to you.
Okay, thank you very much. Okay, if you have been following me on my Facebook and my blogs, all right, I have been calling a market top about 2 weeks ago. I think, and the reason why I'm calling a market tops, all right, for a couple of reasons. My proprietary trade cycles or trade plans is showing that the Wall Street indices could have hit a peak, all right, for now. And I that's my conviction is that we probably have touched the peak for now, and the market is in a corrective wave. All right. So I think you guys, if you have been to enough of these market outlooks, especially at the beginning of the year, the unanimous consensus or the unanimous narrative of the market is bullish. I haven't heard of not one guy that is bearish on the markets. All right. Everybody seems to be bullish. But what I think as as a professional trader and as a market influencer, my job is to help people make money and help myself make money. All right, and I trade a lot of DLC, and I know DLC is something that is very sensitive. It is a leverage product, so it's like your cube of. I mean, if you get it right, the gains are magnified many times. You get it wrong, the losses are magnified very time, and therefore, I have to be very careful about short-term battle. I mean, trading is to me really, whether the market is going up in 5 years' time, 2 years' time, not very important. But what I think is that the current trading environment, all right, we have to look for certain key indicators. All right. So one of those key indicators I want to be sharing with you, which is very important for traders today, all right, is you have seen the short-term interest rate going up, and we have seen the Fed chairman Jerome Powell making a very dovish statement, and he's saying that unemployment unemployment and inflation is a long way off, all right? And he stick to a view that they're not going to increase interest rate for until 2023. All right, so that is the big picture, and that has encouraged a lot of people to continue to be very bullish on the market because they think that the Fed is on their side. But hey, look here, guys. You know, the market is telling you otherwise. All right, the market, the very fact that the interest rate is going up, and you can see copper prices going up, whereas gold prices is going down. Small cap is outperforming big caps. Energy stock is outperforming utility stocks. It is telling you the market, we are in a divergence. All right, the market is not agreeing with the Fed. The market is not agreeing with the bullish the analysis now that everything is going to be benign, inflation is going to be benign, and that is why you're seeing copper price at 10-year high. You're seeing soya beans, soft commodity, weak commodities at 10-year high. We have seen the retail, the retail data just out. It is rolling. It is up 7% year to year. All right. Not only retail, all the economy indicators coming out of US, it is bullish. It is even more than bullish, and yet, right? Can you imagine? If you have been on your CNN news, you will know that the 1.9 trillion package has just been approved. All right, and that's even excluding the $15 minimum pay wage increase, and including that, it will be $2 trillion. All right, and on top of that, a couple of months later, they are going to introduce another 3 trillion of infrastructure. Boy, look at it. It's like 2 trillion plus 3 trillion is 5 trillion of money. It's going to flood the market. What is going to happen? All right, so let me tell you the key point. I did a market outlook with all my clients and my students, out there, and I told them this. All right, what is the difference? I mean, the key thing that we have to be watching up now, all right, is if the Fed is behind the curve, we are all in trouble. All right, so the presumption now is nobody is worried about inflation. It's transitionary. All right, the Fed says transitionary, but what we are seeing, believe what your eyes is telling you. All right, what your eyes is telling you is, everything is surging. All right, so we all know that the Fed, right, in history follows the market. All right, basically when something happens, the Fed is going to react. So the question now is really, with all with the yield surging, with inflation surging, when will it force the hand of the Fed to move? All right, so when will it force it? I mean, so there's a question that we ask ourselves. And when will this, bubble in the stock market pops? As far as the, rising treasury yield is concerned, it's, yesterday it went up to 1.6. The treasury yields, I mean, at the low, it is 0.5, at the pandemic low, 0.5, and we are shooting to 1.6. Boy, it's a big increase. Have you guys ever realized how big the increase is, the interest rates? I mean, interest rate is no big deal, right? I mean, 1.6, really no big deal. But today is a big deal because, debt all over the world, we are all full to the brim, all right? Just the slightest interest rate increase will eat into corporate profits. All right, increase our cost of doing business. And let me just tell you, Emma, I did. Somebody asked me a question. All right, so yesterday when I was just doing a talk, and he asked, the Fed, all right, already said that no big deal. All right, it's going to be, this inflation is going to be transitionary, because they have done it before. All right, 2008, they printed $1.8 trillion. There was no inflation. So somebody asked me, and they said, I mean, what makes you think there's going to be inflation this time? All right. So let me just tell you this. All right. I mean, I told the crowd, the difference now is that we have two QEs. All right. One QE, the first QE that we had in 2008 during the great financial crisis, all right, the money went into supporting bonds and stocks and the financial markets. But remember this, all right, this time around, This time round, we have two QE. One is the monetary QE, another one is fiscal QE. The fiscal QE, all right, will hand checks to the American household. And that's the difference. Can you imagine trillions of dollars going into the hands of American household? What will happen? All right. The velocity of money is going to accelerate, and that will cause inflation. And if Fed is behind the curve, we are in trouble. All right, we are in trouble. All right. So for investors now, the most important thing to be watching is the Treasury yields. All right. So the bad news for Treasury yields is that, you know, I've been asking people, I've been telling everyone, watch the 1.4 mark, the Treasury yields. When it crosses it, 1.4 mark, the market is going to collapse. All right. And it crossed it on Friday, it crossed it. And the 1.4 mark yield, right, is now becomes a support. All right. So as long as it falls back below 1.4, because 1.4 level, the yield, right, it's a 10-year resistance. All right. And when it breaks that, it becomes a support. Okay. And when it comes to support, you know, and if it holds there, it's going to go up to 2, maybe 3, and that's going to cause havoc in the market. Okay. So I think for investors, this is the key takeaway from me. All right, because, all right, I mean, I don't know where the market is going to go 2 to 3 years, 10 years now. I don't know where it's going to go. But I know that, you know, these are the key indicators you've got to be looking at. And as far as the market is concerned, you know, whether this switch, all right, I mean, currently we are seeing a switch from value, from growth to value. I mean, the people are getting out of the tech stocks going to value. So the question is this, all right, this phenomenon happened in 2016. In 2016, we had a similar phenomena of interest rate increasing and investor shifting from growth to value. And, you know, so the tech stocks went down, and that was a healthy correction. All right. Why was it a healthy correction? You know, it was a healthy correction because the bull market sort of expanded. The bull market sort of expanded into other sectors, other areas, not just the tech area. And then in 2017, the tech stocks and the financial stocks, they joined in together, you know, in a huge bull run. All right. So the question is, you know, the current switch, right, from growth to value, from growth to value, is it an expansion of the current bull run, all right, or is it just going to be something that will signal the end of a bull market, all right, which means, you know, the last sector that haven't run is running, all right, it's like the worst stock, all right, is also going up, all right, so that's my takeaway for everyone, all right, watch these key indicators. They are very, very crucial. Okay, I think I've taken out enough time. Thank you very much.
Thank you very much, Robin. So we're going to go to the questions from the viewers right now. And for Keith and Darren, there is a really good question, and it's a fair question. How successful are small traders in leverage products available on the SGX? Let's start with Keith then. Okay. Do you have some statistics on that?
You know, to be honest, it's very hard to see how traders perform on every trade. You know, but what I would say is the investors on DLCs are definitely getting more and more mature. You know, I feel that they understand what they're doing, they understand the product, and the key thing, you know, with trading leverage is how you control risk, right? The risk is very clear. It's 5 times leverage. Okay, it's not going to be 6, not going to be 4, it's 5 times. So if you put in 2,000 Sing dollars on a 5 times long DLC, your exposure is $10,000 on the underlying. Okay, that's very clear. So if my when I trade DLCs in terms of risk perspective, if my view is bullish on a stock and I'm prepared to put in, let's say, an exposure of $20,000 on Tencent, you can do it 2 ways. One is put $20,000 on Tencent, buy the stocks, right? The other way is put $4,000 on the 5 times Tencent long. That is actually giving you the same risk as your exposure. So obviously, with DLCs, there are you know, certain costs and fees involved. There is a compounding effect that you need to know. And talking about costs and fees, look at our website. Every product we actually have show you the daily cost. that will incur for holding it. And basically that cost is very transparent and is not very significant to the price of the product. So I'll say investors are generally getting more mature. And if you go to our website, we actually show you a lot of the information about what investors are doing on DLCs. There's a section on DLC's fund flow. So if you're interested, right, the last 5 days in Hong Kong, the Hang Seng Index came down from 31,000 to 29,000. So what were investors doing on DLC, right? It's all on the website. So what I'm seeing now is the top 5 inflows was in BYD Long. There's close to about 2 million Sing dollars that bought BYD Long 5 times. Meituan Long, there's about 1.3 million. Hang Seng Long, about 1.3 million. So you're seeing that the market's been coming down while investors are actually short-term coming in, buying DLC longs, hope for a rebound in the week to come. And then there are also fund outflows of DLC, meaning investors are selling DLC. So what we're doing the last 5 days, so they basically obviously selling their shorts to take profit, right? Hang Seng was down about 3% on Friday. The Hang Seng 7 times short was up about 21%. What people are doing, they obviously sell their holding to take profit on their short position. So I would say we say retail, but these are SIP investors who have a certain sophistication here, and we're glad that obviously we continue our education efforts. That is all on our website. But I really encourage for those who are new to the product, go to our website, check it out, dlc.societe.com. Thanks.
Thanks very much, Keith. We're moving on to Darren. Darren, warrants have been around even longer. So do you have any statistics or any stories about the success that retail investors have had with warrants? Darren, yeah. Okay, now we can hear you.
Realize that. Okay, great. Okay, so as for when it comes to structured warrants, definitely we've been in the market for around 16 years. So people are more familiar, and especially with taking on positions with higher gearing. And we have seen, that's the reason why we have seen sustained success in HSI. And for the HSI, we typically see a gearing of maybe around 10 to 20 times of gearing. And so I think this shows the familiarity of the product. And also one interesting thing that I would like to point out is in the recent years, we've also seen, as what Keith has mentioned earlier, that investors have become more sophisticated because they have been using the high gearing of warrants and also the low capital that you can use to trade warrants to hedge their positions. So let's take an example, a quick example where an investor has a position in DBS of maybe around $50,000. And he feels that because he shares, he feels that the market is going to come off, but he's unwilling to sell his full position of 50,000, but he wants to hedge this short-term drop. So what investors have actually commented to us is that they have used warrants to actually hedge these positions, where they can buy the warrants at a smaller capital, say maybe just 5,000 with a 10 times leverage to gain the same exposure as a 50,000 exposure to the DBS shares. So this is something that shows the sophistication amongst investors and how investors have used warrants to incorporate them into their trading profile. And another thing that I like to point out is when it comes to warrants, just like all other listed leverage products, they have something called the holding cost. That means that as you hold the product over a period of time, there will be costs incurred. But in terms of warrants, this is in the aspect of time, which is also called time decay. Some of you might have heard of time decay before, that is present in warrants as well as options. So one thing about investors in the market right now is that they are learning how to actually work with this and manage the risk. So one example is, for example, I'll just quote some statistics as you have mentioned. As I'm seeing over here, since the start of this year, from the last trading day, 31st of December last year to 25th of January. So that's where we actually see a lot of the tech stocks actually rose. And for Tencent shares, during this period of time, it actually increased by 36%. And compared to a Tencent call, despite holding it for more than 3 weeks, you see that the call increased by 327%. So this is a 9 times increase compared to the Tencent shares, despite holding it for more than 3 weeks. So I think this is also ways to show that investors are comfortable and learning how to manage all these features of warrant trading. And as Macquarie, we are also very happy to support all these trading trading techniques. And that's why we have come up with new tools, such as the Warrant Selector tool, that you can find it on our website, warrants.com.sg. We can see all these new tools that help investors calculate their holding costs and as well project their returns if, let's say, they have a view, and they also have a specific holding period. So all these tools are introduced to help investors kind of find the right warrant that suits them best. And of course, Macquarie is always open to feedback, and we are always constantly changing to improve the trading experience of trading warrants. So
thank you, Darren.
I think I'll hand it over to you.
Much appreciated. We've got about 5 minutes left. I'm going to go over to Kon Hao and Robin because it's not, you don't just use warrants and DLCs as pure trading tools, right? You can also use it to hedge your existing share positions, and that's quite practical, and it's something that I don't think we've discussed yet. So could I just trouble Kon Hao and Robin? We start with Kon Hao. Just could you give us an example of how to use warrants as a hedge?
Say, for example, if I have the Hang Seng Tech Index earlier mentioned, say, for example, I have one of the stocks that is very heavy weighted that I'm not in time to cash out. Even last Friday, I saw there's a signal that market is coming down. But say, for example, because the mandate is different, say one of the, say, Meituan, Meituan is one of the constituent. I've invested heavily, say, for example. But from the index itself, I saw that market is coming down. But the Meituan is for long-term investment, so I do not want to touch it. But yet, I know through the Hang Seng Tech Index, I know that the Asia tech stock should have been coming down. That's based on last Friday closing, which it did. So what I could do, how I hedge, because Meituan is for long-term investment, but knowing that the tech stock is about to come down. So what I could do is that on Monday itself, I can email your broker. In this case, my friend is Darren, happened to be, or you can go to the selector to choose. Go and look for the put, So basically, as of last Friday closing, I'm very confident that market should come down. Of course, there's never 100%, right? So earlier I did mention that the greater the confidence, the higher the gearing I would deploy. So it's a it's a very new contract for the structural world for Hang Seng Tech Index. I may want to go for the max, which is the 10 times. I think it's 10 times because it's so new. Buy a 10 times put Hang Seng Tech Index, and that became a hedge whereby I'm still holding my Meituan, but in the same time I'm long on my put for my Hang Seng Tech Index.
Oh, that's a great example.
Yeah.
Thanks, Kon Hao. And also for Robin, could you give us an example of how you will use DLCs to hedge?
Okay, so yesterday, last week, all right, I had quite a lot of hedges. All right, so I did quite a lot of hedges because there was a conflict within me, and that conflict within me really it's about the Singapore banks were really moving ahead. All right, and I could see traditional stocks like CCB, China Construction Bank going up, and we could see like the telcos going up. So I was bullish on those, and I was bullish particularly on commodities. All right, and I was buying a lot. I mean, if you have been following me on my chat, I've been buying a lot on Pacific Basin. Right, it's a bulk carrier. And really, because of my belief that we have entered a commodity super cycle, and yet, right, when I look at all the Wall Street indices, they are all toppish. They were about to fall. All right. So while I was like, very bullish on the value stock, which is the banks and also the commodities. And yet, right, on the back of my mind, the market it's showing weakness, especially the big indices, the tech indices. So what I did really was to buy a lot of short DLC on the HSI tech index, and as a hedge, okay, and bought a lot of. I also bought, and when you see Tesla coming down, I mean. Last week, you could see that Tesla was diverging. The rest of the market was going up, Tesla was going down. So when Tesla is going up, what do you short? You short car companies, right? So obviously, the car company on the Hang Seng was BYD. All right, so I bought the short BYD, all right, to hedge the rest of the portfolio, and it turned out great. All right. So, but if you are in a situation where you have, the market, firing all cylinders, right? That means every sector is running. Then you don't have to do that. All right, you don't have to do that. But if you have a conflict now, like what I have now, that's what I would do. Yeah.
Thank you very much, Robin, Konghao, Darren, and Keith. Some very practical examples there also. And I'm just going to share this slide to show everyone some of the counters that are available. So here we are. So some of the underlyings that were present that we discussed. So these are the DLCs on the left, the warrants on the right. These are just some of them. There's plenty more, as we mentioned earlier. And also, please do scan those QR codes if you'd like to learn more about DLCs and warrants. The QR code on the left is for DLCs, warrants on the right. And finally, we'd like to remind everyone that there is a simulated trading challenge happening next Monday to Friday. Top prize, $5,000. All right, it's not real money. So I think, spoiler alert, one of the ways you can put yourself in pole position for this, I think, is probably through DLCs and or warrants. So keep that in mind. If you missed out any of the things that our speaker said, not to worry, you can watch this session again. All of the sessions today are available on this same platform after the end of this event. So once again, thank you very much to Darren, to Keith, to Konghao, and Robin for sharing your wisdom and sharing all this wonderful knowledge with us. And thank you to our viewers for joining us today for the Singapore Trading Festival. We wish you all the very best.